Welcome back to Daily Market Insights for Friday, August 14th, 2026. Today marks the highly anticipated second quarter institutional 13F filing deadline, and the disclosures did not disappoint. NVIDIA surprised Wall Street by revealing a massive $21 billion stake in SpaceX as its second-largest holding, while Broadcom fought off heavy selling over recycled reports of off-balance sheet AI debt. Meanwhile, a surprise drop in July retail sales has cooled interest rate fears, leaving major indices coiled tightly beneath key resistance. Let's unpack the real signal behind today's market moves.
The major indices closed modestly lower today as the S&P 500 continues to consolidate just below the 7,800 milestone. The major catalyst across the macro tape was the July retail sales print, which unexpectedly fell 0.6% month-over-month, against expectations of a 0.1% gain. Core retail sales, excluding autos, slipped 0.3%. While some of this softness reflects calendar distortions from Amazon Prime Day shifting into June, consumer spending is clearly cooling from its earlier peak.
This retail slowdown, combined with yesterday's benign wholesale inflation print, is actively reshaping the interest rate landscape. Market-implied probabilities for a Federal Reserve rate hike in September have tumbled to roughly 35%, down from nearly 70% just a few weeks ago. With consumer demand moderating and energy prices stabilizing, the policy focus is visibly shifting away from additional tightening and toward assessing the underlying resilience of domestic growth. Turning to today's corporate headline, NVIDIA's official second quarter 13F filing revealed that the chip giant holds 122.8 million shares of SpaceX, valued at approximately $21 billion. This holding, listed under ticker SPCX, following earlier private market conversion rounds, instantly becomes Jensen Huang's second-largest disclosed equity position. It shows how NVIDIA is converting its unprecedented cash generation into strategic equity across the broader frontier technology landscape. Looking across the rest of NVIDIA's portfolio, Intel remains its single largest position, with over 214 million shares held. Furthermore, NVIDIA continued expanding its commitments to emerging specialized cloud providers, maintaining balanced stakes across Nebius and CoreWeave. Rather than hoarding hash or relying solely on traditional buybacks, NVIDIA is actively using its balance sheet to cement long-term demand for its computing architecture across independent cloud ecosystems. While NVIDIA pushed forward, Broadcom experienced sharp volatility today, with shares sliding roughly 6% after media outlets recirculated a Bank of America analyst note. The report highlighted that off-balance sheet AI computing financing vehicles, partnered with private credit giants Apollo and Blackstone, could accumulate up to $370 billion in senior debt by mid-2029 across a 20-gigawatt build-out. Algorithmic selling quickly pushed the stock down toward its 200-day moving average. A closer look at the actual filing reveals that this sell-off was largely driven by recycled headlines. Bank of America actually raised its fiscal 2026 revenue forecast for Broadcom by 10% and its EBITDA forecast by 13%, pointing to adjusted EBITDA margins of nearly 69%. The $370 billion figure represents the long-term gross capacity of the entire third-party vehicle, while Broadcom's maximum theoretical guarantee exposure on the initial $35 billion tranche is capped at $29 billion. The underlying operating business remains exceptionally profitable. In another major 13F disclosure, Bill Ackman's Pershing confirmed a brand new position in Netflix, purchasing approximately 3.15 million shares to make it a 4.9% portfolio weighting. Pershing also reaffirmed its substantial 7.63 million share stake in Uber, which accounts for roughly 12% of the fund. This marks Ackman's high-profile return to Netflix, 4 years after exiting during the 2022 streaming downturn. Ackman's investment rationale centers on a disciplined fundamental screen. Out of the entire S&P 500, Netflix and Uber are among the only large-cap companies trading near 20 times forward earnings while projecting over 40% earnings growth. With Netflix demonstrating pricing power and accelerating free cash flow conversion from its ad-supported tier, institutional capital is rewarding durable platforms that can grow independently of broader economic cycles.
On the policy front, President Trump signed an executive proclamation today enacting tiered tariffs ranging from 10% to 100% on imported unmanned aircraft systems and drone components. Designed to address national security concerns and stimulate domestic manufacturing against dominant overseas producers, the policy sparked an immediate surge in domestic drone makers, with shares of unusual machines rallying sharply as capital pivoted into domestic supply chain beneficiaries.
The asset management landscape saw a major shakeup as Goldman Sachs Asset Management agreed to acquire Neos Investments for up to $2.25 billion. Neos manages $30 billion across 19 options-based income funds, including flagship retail ETFs like SPYI and QQQI. Following its earlier acquisition of Innovator Capital, this deal pushes Goldman's total ETF platform to $130 billion, highlighting the soaring retail demand for systematic yield and downside protection.
Across mega-cap tech, cash generation dynamics are creating compelling valuation divergence. Amazon's trailing 12-month operating cash flow margin has climbed to an all-time high of 20.81%, underscoring massive efficiency gains across AWS and logistics. Meanwhile, Meta is trading at a forward price to operating cash flow of 8.6 times, compared to its historical median of 12.3 times, offering an attractive cash generation profile despite ongoing infrastructure investments. To wrap up today's roadmap, markets are digesting a clear transition. The surprise decline in retail sales has reduced immediate interest rate risk, while today's 13F disclosures highlight institutional capital rotating into proven cash flow compounders like Netflix and strategic infrastructure plays like SpaceX. As the S&P 500 coils below major resistance, maintaining disciplined exposure to high-margin cash generators remains the most reliable strategy. Thank you for watching, and we'll see you on Monday.